Hey everybody, Boris. Welcome to the weekly technicals for January 16th to January 20th for the Aussie dollar, dollar CAD, and Kiwi dollar. And I think the story in the COM dollars this week, of course, was the surreptitious, the kind of very quiet, but nevertheless pretty persistent return of the carry trade. The COM dollars have gotten smashed by the fact that U.S. yields have risen, of course, since the Trump election, and then it compressed the carry trade differential between the U.S. 2 years and the Australian 2 years and the New Zealand 2 years and the CAD 2 years. And it certainly created a very vicious sell-off in both of those currencies, even though on a net basis they still provide a much higher interest rate differential than the U.S. dollar. This week and actually the week prior before that, last 2 weeks, we've seen a pretty serious reversal of U.S. rates off their highs, and therefore a positive flow back into the Aussie, back into the Kiwi. And we now find ourselves at sort of these recovery highs against some pretty serious resistance on both sides, but potentially I still think a little bit further upside in both trades. We don't have too much data, although we do have, of course, Australian employment data, which should be relatively good. New Zealand doesn't have anything significant. Canada only has retail sales. Canada really is sort of an oil trade anyways, in so many ways. But the story with commodity dollars has been, of course, for the last several months, that it's a low volatility story, that it's a sort of it's a way for you to participate in either a pro-dollar trade or an anti-dollar trade with a much lower volatility footprint, where the moves are going to be 50 points instead of 150 points, where the drawdowns would only be maybe 100 points instead of 200 points, and therefore a more conservative approach to trading whatever position you want to take. Still think that the anti-dollar trade, as I said, in the majors, in the key majors, is pretty much also dominant in the COM dollars, and therefore it's really going to be a trade in the U.S. yields in many ways. Ultimately, it's really, the COM dollar trade ultimately will be a trade in the U.S. yields. If U.S. yields again dip closer towards the 230 than the 250, the COM dollars have a chance to push a little bit higher. As far as the levels go, we are at some pretty serious resistance levels, but we could break a little bit higher. Aussie dollar is hitting its head against the 75. 75.50 is a true resistance. 73.50 now becomes support. Dollar CAD coming down all the way to this very key 130 support level, with now 133 the resistance. And Kiwi also improving a little bit slower, but also improving with 72 still a very big resistance. If you look at the charts here, the resistance becomes very clear technically. This whole 75, former support, now becomes resistance. It will take a push to get us higher. But what is, I think, encouraging for those who are trading on the bullish side is just the buying of especially over the last several days. Let me go back again to the 4-hour chart here, and you can see the just a very powerful buying over the last several days on the 4-hour chart with very shallow retraces. This is a highly bullish sign where the trade goes 50, 73.50 up, and only finds sort of correction back down to 73s. What can compromise this move? A high move in U.S. yields. U.S. yields break 5-10 basis points higher. That would probably precipitate a correction all the way down to 74s. But even a 74 correction is more of a buy to dip correction than it is a calling of a top. At very minimum, I think even if it corrects to 74.50, 74, it will try to make a second move back up, unless the dollar rally really begins to take off and you have a V-shaped comeback. It's unlikely. Technically, this is still showing a much higher probability of buying a dip than trying to fade the rally at this point. Let me go back to the dailies here. The key thing on the dailies, of course, is yes, these are key resist points. The highs over here. Let me put the display window around 75.25, 75.22. So this whole 75.50 very key level. But what could be interesting is if it does break through here, the amount of stops that are resident around these levels probably could create a pretty serious vortex. And I think if 75.25, 75.45 is given, there's a high probability we'll squeeze straight out to 76, which then becomes a deeper area of resistance, because that was a big area of support here further down the road. When you look at dollar CAD, It's of course a story in reverse, but I think the story here is also very interesting because this 130 level, um, yes, big support, big dip here, but when you look at dollar CAD here, this move to the downside is relentless. You have a series of lower highs, you have just complete failure at every point we're making, and only a recapture back above really to be completely confident, the recapture has to be back above the 133s, but 132s on a closing basis. In other words, if we have a couple of days next week where we close above the 132s, only then can you sort of feel with a higher degree of confidence that this is a bottom and dollar CAD goes back up to the upside. In the meantime, now a break of the 130s really sends a very bearish signal against the dollar. This is sort of my argument that the dollar yen is the first line of defense in a dollar correction move. In other words, if that breaks the 1375, that's a strong signal dollar corrects further. But dollar CAD is yet another good secondary support signal of dollar weakness. If we break the 130s, that really puts us much more further towards the 129, 128 target in dollar CAD. So really worth watching this for the next couple of days. If we get further price action towards the 130, suggest dollar weakness could really take us all the way to 29. In order for us to sort of stabilize the dollar, I would have to see 132 on a closing basis for dollar CAD. Last but not least, in the COM dollars, the Kiwi dollar is mirroring, all the price action in the Aussie on a more modest scale. The 72 is a much harder resist point here in the Kiwi dollar, and I think that 72 is going to be much tougher to break through. So if you're looking for if you're looking for it's sort of interesting. If you want to reestablish dollar longs against the carry trade on a longer term basis, then waiting patiently, if you get the Kiwi towards the 72, opening up the shorts at the 72, 73 level probably would be a very productive trade on a longer term basis for a move back down to 69. But for now, on the near term basis, it's a buy to dip trade, very much like the Aussie, with a push towards 72, a much more likely scenario. So that's how the COM dollar shape up. It's really, as I said, very much the purest probably trade on U.S. rates. And if you at this point see U.S. rates drifting back lower, this is going to present the best opportunity for further upside in all the COM dollar moves. Wish you guys the best of luck, the best of trading. Boris Lossberg over and out.